Thank you, everybody, for joining us for this evening's training. And I can't tell all of you what you're going to take out of this, but I will tell you that if you apply what you're about to learn, it will, and I can say this truthfully, it will change your financial future. It will change the way you use money forever, and it will put you back in control of your money. If those three things aren't compelling enough for you to spend the next hour and let's just say 40 minutes with us, then you obviously have to put your priorities in a different order. But you're all here, so I know that each and every single one of you are ready to change your lives. And the one thing I will tell you is we are going to help you do that tonight. Mr. Brent Kesler is going to give the presentation that I saw so long ago. And let me just tell you the story, and then I'll turn this over to Brent because it's a good one. So I was a financial advisor for 16 years of my life. I knew what life insurance was. I knew what all the different life insurance was. And also I knew investments. I knew them really well. That's what I did for a living. And no one could ever tell me that, there was a better thing to do than put money into the indexes or the S&P 500 or anything investment related, because that was my space. So I was doing real estate and I was flipping houses, which means I needed money. I had been introduced to this guy, Mike, who was a really wealthy guy. He had a TV show and he was lending me money on my real estate deals. I happened to be in Utah on a snowboarding trip, and me and this gentleman, Mike, met out at a cheesecake factory to discuss a deal that I needed funding for. So we're sitting down at Cheesecake Factory and going over the deal. And I just said to him, I said, so Mike, just how do you lend money? Like, where do you lend from? And without even flinching, he just said, I lend from my private bank. Now, instantly, the first thing that I think a lot of you would think if you were in that situation is, whoa, this dude's got a bank? Man, I way underestimated how much money Mike actually had. And I said to him, I said, so Mike, like, why don't we go to your bank? I'm thinking I can go to his bank, get myself a dum-dum sucker, maybe a cup of hot, black, nasty coffee, whatever. Let's go to your bank, dude. And he then proceeds to tell me that he doesn't have a physical bank, but he created a banking system. And that banking system allows him to lend money. And then I just told him, hey, tell me a little bit about it. He said all those things the video did. Well, I put money into this. He didn't tell me what it was. I put money into this vehicle. I then immediately take the money out. I lend it to people like you. You pay me interest. I put the interest back into my bank. But you see, the one thing that's interesting is all of the money that I put into the bank never stops earning interest and dividends, even when I take it out and give it to you. Now, right off the bat, I'm like, okay, something's wonky here. You can't put money in the bank, Mike, and take the money out and give it to me and still earn interest and dividends on the money. And he says, well, that's what I do. And he said, and also all the gains that I get are all tax-free. So he's got me all riled up over here. I'm like, dude, I just landed some information that I'm going to take back, and I'm going to be able to make a ton of money telling all of my clients about this amazing thing. And then he drops the bomb on me and he tells me what this vehicle was. And he says it's a whole life policy. Instantly, it was like nails on a chalkboard. I'm like, dude, who got a hold of you and lied to you about your whole life doing this? Because he had told me he puts money in and immediately takes it out. At the end of that conversation, I was intrigued and I wanted to learn more. And I said, Mike, can you teach me this? And he said, no, you got to get a hold of the guy that taught it to me. His name's Mr. Brent Kesler. He gave me his number. Brent, you probably remember this day, but I was driving back to my friend Jack's house from Cheesecake Factory. I dialed Brent, and I probably sounded like a blender with its top off. Hey, Brent, I just got done with this guy, Mike. I'm a financial advisor. I know all about this stuff. I need to set up my own bank, blah, blah, blah. And Brent stopped me, and he said, have you watched the 90-minute video? Now, I'm going to pause that conversation there. I did not want to watch a 90-minute video. Under no circumstances. I thought I knew everything. I thought I knew what I didn't know. But I did watch that 90-minute video, and forever, and mark my words, folks, forever, that changed my life. It changed my family's life. It will change my daughter's life. It will change my daughter's kids' lives that I will probably never even know. Like their kids will be taught this and will use this. And I won't even know their names. But the one thing I can mark my words here, this grandfather, which is what I'll be at that point, will make sure that every child in this bloodline receives a check on their birthday from grandpa. Now, some of these grandchildren will not know who Grandpa Chris is, but they'll get a check every single year with my name on it, wishing them a happy birthday. How many of you want to leave a legacy like that? And if it is, all you need to do is pay attention to the next 90 minutes. And Brent Kesler will show you the path that I was shown, the path that Hannah was shown, and the path that so many of you were shown. And that path will lead you to that place. So, Mr. Brent Kesler, are you ready to get going?
I'm ready, Chris. Can you hear me?
Yes, the show is yours. You have the ability to share, so let's rock and roll. I'm going to pin you
right
up there.
Yep, the hardest part is me getting the share, so let me try to get that going.
Just some housekeeping before we get into it, like we mentioned on last month's. So the first half of the session, we're going to go through the presentation, and I know some of y'all have seen it, Mr. Drew, and some of y'all have seen it multiple times, but it's good to see it over and over again. So we're going to walk through the presentation, the first half, and then the second half, we have some advanced training and some really cool material we're going to get into. But all of this builds on top of each other, and you know, you got to stay up to date and in the know of the infinite banking concept. So all right, we're ready.
And one other thing
good.
real quick, Brent, before you go, folks, you're going to have a lot of questions as you go. Hannah and myself are here to answer those questions, and when Brent's done, I'm going to do an advanced training. So if you've got things that this video does, or this training does not go over, I will be happy to make and teach you anything you want in the advanced training session.
Okay, good deal. So yes, as Chris and Hannah said, if you have seen this presentation before, it does not hurt you to watch it a second, a third, or a 10th time, because every time you watch it, you will get something new out of it. It's just like if I read this book here called Becoming Your Own Banker by R. Nelson Nash. I've read that book, I don't know, probably 70 or 80 times. And every time I read it, I get something new out of it. So just keep an open mind as I go through this. I'm going to go for about the next hour and a half. And then after that, Chris and Hannah will take over and they'll do advanced topics. But as Hannah said, everything is going to build up on each other. So the first thing I want to do is I want to apologize just because of my voice. I've kind of been under the weather for the last 2 or 3 days, bad cough, sore throat, even have an earache. I'm feeling a little bit better, but my voice is still kind of crappy. I'm sitting here drinking a lot of water and I'm like sucking on these throat lozenges. So I apologize for my voice, but the information is going to be the same whether I have a voice or whether I don't have a voice. So I just want you guys to keep an open mind as I go through this. And yes, you're going to have questions. I'm not going to take questions as we go through it, but as Chris said, make sure you put those questions in the Q&A, and Hannah and Chris will be answering those questions as we go through, and we will stay on as long as we have to tonight to make sure all of your questions are answered. All right, so let's go. So basically, who am I? So anyway, my name is Brent Kesler, and we are with the Money Multiplier. Now, we're located here in Port Orange, Florida, about an hour east of Orlando. And if you notice on the home screen, there's basically, it has all of my information. It has my texting number, my email, and also our website, themoneymultiplier.com. So the concept that I'm going to teach you, everything we're going to talk about is your money and your wealth. So that's what the topic is going to be for about the next 90 minutes, is basically just like your money. And I want you to keep an open mind. I'm not trying to convince you of anything. There's nothing I'm going to ask you to buy at the end of this. Hopefully, if you like the information that we share with you, if you decide to implement and start doing this process in your own life, hopefully we are the ones that you will decide to start this process with you. Now, so this topic called the infinite banking concept, I actually heard this concept back in 2006. Now, for all of you, like of those that don't know me, I'm actually a chiropractor. I no longer practice chiropractic anymore. I had 5 clinics in the Kansas City area. So I have not been practicing chiropractic since 2008. I had associate docs in my clinic, and so this concept that I'm sharing with you tonight, I've been teaching it since March of 2012. So about 11 years and 3 months now, I've been teaching this concept. So anyway, back when I very first heard it was it was all the way back in 2006. And I was at a chiropractic conference, and I heard somebody speak on this infinite banking concept. And I was like, man, that sounds really, really good. However, it just sounded too good to be true, right? Have you guys ever seen something like that where you watch something and it looks good, but it just seems too good to be true? Well, that was me back in 2006. So I heard this information. I watched it. I actually went home after that conference, and I did nothing with the information that I heard. So I go back to another chiropractic conference almost 2 years later, and about 10 or 12 of my colleagues that were at the previous conference are now at this new conference. The only difference between just me and them is they took action and they implemented as soon as they heard it. So here I'm at this new conference in 2008, and about 10 or 12 of my colleagues are coming up to me. They're basically throwing up all over me. They're saying, Brent, isn't this banking concept the most powerful thing ever to build, keep, and create wealth? And they were just going on and on and on about it. And I thought to myself, there had to be something to this, right? There's no way that 10 or 12 of my colleagues are lying to me. Maybe one or two, but not 10 or 12. So I came home and I told my wife, I said, honey, I said, we have to start implementing this in our life. And it was in February of 2008 that I found myself $984,711 in debt. That's what I owed the third-party creditors. Now, I know what you're thinking. You're thinking, so anyway, okay, so how does a guy from Kansas get to be almost $1 million in debt? I know if you live in California, that buys you a very small house, but in Kansas, it buys you a lot. Well, I had my student loans from chiropractic school. I had the house that I lived in. I also had a house on the Lake of the Ozarks between St. Louis and Kansas City. And if you have a house on a lake, guess what else you have to have? A boat and a wave runner, right? I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it didn't take me a lot to become almost $1 million in debt. Well, I was able to apply this concept that I'm going to share with you tonight. And I was able to pay that debt off in 39 months. 3 years and 3 months. And all I did was added one step in my financial life. And that's all I'm going to teach you to do is add one step in your financial life. Because look, I don't want you to change your cash flow. I don't want you to work any harder. I don't want you to take any additional risk or lose control. All we're going to do is add one step in our financial life. Okay. Now, the concept that I'm going to share with you, I didn't create it. Chris didn't create it. All right. It's been around for over 200 years. So the way that I learned about it was through this book called Becoming Your Own Banker by R. Nelson Nash. Now, R. Nelson Nash, he passed away back in March of 2019. So a little over 4 years ago at age 87. This book completely changed my financial life. This is a book that you want to add to your wealth building library. And if you're like me and have a little ADD and don't like to read, you can also get 2 hours of audio as well as the book. So this is a book that you want to have in your financial library. Actually, there's another book that Chris Naugle and I wrote a few years ago. It's called Mapping Out the Millionaire Mystery. Now, everybody on this call tonight, we will send you the ebook version of this book. All you got to do is send me an email, Brent@themoneymultiplier.com, and I will send you the ebook version of this book. So just to be clear of what I'm going to be talking about for the next almost 90 minutes, that's right. We're going to talk about money, and I'm going to talk to you about how to recycle and recapture all of your money. And you're thinking recycle and recapture. Tell me, what does that mean? Well, it doesn't matter, like anything that you buy, any product or service that you buy, the thing you have to do is you have to give them the money, and then in exchange, they give you the product and service, and the transaction is over, right? So in other words, they have the money and you get the product or service that you just purchased. Well, how about if there's a way that all you have to do is add one step in your financial life, and now you're able to recycle and recapture all of those dollars for everything that you're buying. Before I end tonight, I'm going to show you how to get all the money back on all the cars you're ever going to buy, drive, and own for the rest of your life. And you're thinking, well, what does that mean? Get the money back for my car. Well, again, so I don't even know you, but I know how you buy cars. There's only one of three ways that you buy cars. You either pay cash, you bank finance, or you lease the car, right? That's right. You all have to give money to get the car, because I don't think you stole the car, because all of you look pretty honest on here? Well, a couple of you look a little shady, but most of you are pretty honest. So what you have to do, you have to give the money to the car dealer. Car dealer gives you the car. He's got the money. You got the car. Transaction is over. But by adding that one additional step, I'm now going to show you how to recycle and recapture and get all the money back for that car. So not only do you have the car, but you get the money back as well. How cool would that be? And if I can show you how to do that with a car, guess what else you can do it with? Anything that you want, a house, a boat, a bicycle, a vacation, your charitable giving, your taxes, anything at all. You're going to turn every liability into an asset, every depreciating asset into an appreciating asset, all by adding this one step in your financial life. Now, I'm going to give you a little homework, and here's your first homework. After I'm done tonight or tomorrow morning, or I would just stay up late and do it tonight, I want you to go out and watch this. I want you to watch this video. It's on YouTube. So go to YouTube and just plug in the backward bicycle, and it's about an 8-minute video. And when you watch that video, you're going to understand why I had you watch it, because what I'm going to go through with you tonight is a paradigm shift. It's not what you've been taught about money. It's not what you're doing with money. It's not what your parents are doing, your grandparents, your friends, your colleagues, and your coworkers. So this is an outside of the box concept. So I want you to keep an open mind. But remember what I said earlier. The concept is not new. No. It's been around for over 200 years. This is what the wealthy do to build, keep, and create wealth. This is what the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays do. So I'm going to give you a little clip of the video so you know that when you go watch it later, you're on the right one.
Hey, it's me, Destin. Welcome back to Smarter Every Day. You've heard people say it's just like riding a bike, meaning it's really easy and you can't forget.
Okay, so there you go. So there's a guy named Will Rogers, and here's what Will Rogers says. He says, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So a lot of the things you've been taught about money are not actually the truth. So let's go through some of those things and you'll see exactly what I mean. We're going to talk about how does your money flow, the method to get all your money back. Remember what I said earlier, we're going to show you how to get all the money back for everything in your life that you're buying. So not only do you buy the product or service, but you're able to recycle and recapture and get that money back. We're going to talk about the mysteries of money. The machine. Pretty soon, I'm going to show you what that machine is that we're going to use to build, keep, and create wealth. And it's going to surprise a lot of you when I show it to you. We'll talk about the mission and the marathon. This is not a sprint. It's not a get-rich-quick deal. This is about you adding one step in your financial life. And when you do that, it will drastically improve your financial life. We'll talk about the millionaire and the movement. All right, so let's get into it. I have 3 calculators on the screen, and I know the last thing you want to do on a Tuesday evening is math, but I'm going to make it pretty simple and pretty easy for you. So on the calculator on the right, this is your savings account or checking account at your local bank. I am going to assume that everyone on this webinar has a checking or savings account at a bank, okay? And I'm going to be your banker. So we'll just call me Banker Brent, all right? And I'm going to say that you have $25,000 in your checking or savings account. And in that account, you're earning 4% interest. Now, I know you're not earning 4% interest on your checking or your savings account, but I'm going to make believe that you found a really, really good bank, and that bank is paying you. And anyway, that bank is paying you just an interest rate of 4%. And as I said, I am your local banker. So I'm the banker at that bank. And here's what you do. You come into the bank and you say, Brent, I want to take my $25,000 out of the account where I'm earning 4%, and I want to go pay cash for a car. And I say, no. You do not want to take the $25,000 out of the bank to go pay cash for the car. Instead, what I'm going to do is I'm going to make you a loan of $25,000 and I'm going to charge you 6% interest. Now, let's say we all go to the bank to borrow money to buy a $25,000 car. How long are we going to finance that car for? 5 years, 4 years, maybe even 6 years. It doesn't matter how long it is. In this case, we're going to say 5 years or 60 months. It doesn't matter if it's 4 years or 48 months or 6 years or 72 months. So here's what I'm saying to you. I want you to keep the money in your savings or checking account earning 4%. I'm going to make you a loan of $25,000, charge you 6% interest, and over the same equal time period, in this case, 5 years or 60 months, our bank will pay you more money on the 4% that you're earning than you will pay us on the 6% that you're borrowing. Now, is that a true statement? In other words, is it possible for you to make money if you earn 4 and you pay 6? And I see a lot of you shaking your head no, because here's what you're thinking. You're thinking, if I earn 4 and pay 6, I'm losing 2. Well, that's the way that my mind also worked when I saw this presentation for the first time. If I earn 4 and pay 6, I'm losing 2. However, the banker told you the truth, and let's walk through it. If you borrow $25,000 at 6% for 5 years, your monthly payment is $483.32 a month. You take $483.32 times 60. So that means over the course of those 5 years or 60 months, you are paying almost $29,000 for that car. $25,000 in principal and $4,000 in interest. Are you with me so far? That same money over here in your savings or checking account at your bank, that $25,000 earning 4% over the same equal time period, 5 years or 60 months, you actually have a total of $30,525. Now, here's my question. Is this number right here, 3525, a larger number than 28,999? Or do you guys do math differently than I do in Florida? That's right. It's a bigger number. Well, how can that be? How can you possibly have more money earning 4 at the same time you're paying 6? Well, here's what's going on, ladies and gentlemen, boys and girls. The car balance is on a decreasing balance. You're paying that down every month. It's going down. It's on a decreasing balance. The money that you have in your checking or savings account earning 4% is going up. So one goes down and the other one goes up. But see, our minds are not programmed to think that way, because we think if we earn 4 and pay 6, we're losing 2%. We have to start learning how money works. Now, all I wanted to do is prove to you that you can make money all day long earning 4 and paying 6. Now, why is that important? Well, there is a method to my madness, and let's go through that. The machine that we're going to use to build, keep, and create wealth. Are you ready for it? Here it comes. The machine is a whole life policy in a mutual company that pays dividends. Now, I wish you could see a lot of your faces right now, because here's what you're saying. You're saying, what? A whole life insurance policy to build, keep, and create wealth? Why on earth would I ever want to do that? I mean, why would I want to build wealth by using a whole life insurance policy? A lot of you are saying, I know everything there is to know about life insurance, and I would never want to use that vehicle to build wealth. Well, let me just tell you, you do not know everything there is to know about this, because if you did, you would already be implementing it in your own life. So why are we going to use a whole life insurance policy to build, keep, and create wealth? Well, there's a lot of reasons, but the number one reason is because this is what the wealthy do. This is what the rich do. The number one purchasers of whole life insurance in the world are conventional banks. Conventional banks own more in whole life insurance than all of their land and their buildings combined. Now, keep in mind, this is not any whole life insurance policy. No, no, no. This is not the life insurance policy that you can go and buy from your brother-in-law that sells life insurance. No, this is a specifically designed, specially engineered whole life policy that has high immediate cash value. One more time, high immediate cash value. And when I say high immediate cash value, that means you can start using the cash value in this policy within 30 days. It's not the policy you can buy from your brother-in-law, right? We all have a brother-in-law that sells life insurance. No, this is that specifically designed, specially engineered policy. Now, I just told you that conventional banks are the number one purchasers of whole life insurance in the world. Well, how can you check that out to make sure I'm telling you the truth? Go and Google something called BOLI, B-O-L-I, which stands for bank-owned life insurance, and you will see the hundreds of pages that come up on how much whole life insurance conventional banks actually own. So all we are going to do is we're going to imitate and we're going just to mimic what the wealthy have been doing for over 200 years. We aren't going to reinvent the wheel. All we're going to do is add one step in our financial life. We're going to put money into a whole life policy, and then we're going to use the money after it goes into the policy to buy all the things that we're buying in life anyway. So let's go back to the 4 and the 6%. Why is that important? Remember, I said there is a method to my madness. Well, why are the 4 and the 6% important? Well, the 4% is important because inside of your policy, the guaranteed growth rate with the dividends is greater than 4%. But I only use 4% because I always like to underpromise and overdeliver. In every one of my presentations and all of my, the thing, you can Google my name, you can YouTube my name, and I have lots of different videos, lots of material out there. All of my material, all the numbers I show in real life, it actually works better. So I like to always underpromise and overdeliver. So the growth rate plus the dividend in the policy is over 4%. Now, let me ask you this question. Is that 4%, is it taxable growth or is it tax-free growth? That's right, it's tax-free growth. And what is our largest eroder of wealth? Taxes. Now, why is the 6% important? The 6% is important because that is the highest interest rate the insurance company is going to charge you to take a policy loan. And I will tell you, we currently have no insurance companies that we work with that are charging 6% for policy loans. So again, my numbers that I'm showing you here, they actually are better in real life. So can we make money all day long earning 4 at the same time we're paying 6? And the answer is yes. Okay, so let's move on. Now, okay, the thing we have to agree on is what is the definition of money. So if I ask you to tell me the definition of money, you would give me a lot of different answers. The definition of money, all money is a means of exchange, is it not? All we do with money every day is exchange it for products and services. In other words, I exchange money for food, food for money, car for money, money for car, house for money, money for house. All it is a means of exchange. So that's our definition of money. Now, who in here believes in compound interest? Yeah, you've all are raising your hand. You believe in compound interest. You've been taught compounding is a great thing. Well, let's talk about compound interest for a minute, okay? In order for your money to compound, your money has to sit still, does it not? Yeah. So like if I want this $20 bill that I have in my hand to compound, I have to take it to the bank. I give it to the bank teller and I have to keep it in the bank. So if I go back to the bank to get that money in a week, a month, a year, that money is no longer compounding, is it? So it has to sit still. Well, motion is a natural law of God. Everything is in motion, right? I'm talking, my lips are moving, my hands are moving, the cars are driving by, the birds are flying, right? Everything is in motion. How many of you would want to eat fish out of a stagnant pond? Nobody. Let me ask you this question. How many of you went to the grocery store this last week? You went through the fresh produce section of the grocery store. How many of you actually purchased fresh produce that you do not intend on eating? The answer is none of you. Because if you don't eat the fresh produce, what happens? It's going to rot and spoil, right? So it has to stay in motion. But compounding stops the motion. However, we've all been taught compound interest is a great thing. Well, I want you to name me one business in the world. You pick any business that you want. Name me one business in the world that actually uses compound interest. Now, you guys give me a lot of different answers, but the one common answer I get all the time is banks. Banks use compound interest. Well, let's think about that. Do banks really use compound interest? No, they pay you compound interest and they charge you compound interest, but they don't use it themselves. So here's what I mean, okay? If I took this $20 bill, okay, and I took it to the bank, and let's say I highlighted it in yellow and I put my initials on it, and I go put that $20 bill in the bank, and if I go back and get that $20 bill, say in a week, are they going to give me the same $20 bill back? No. What about if I go back and get it in a day or an hour or 20 minutes from now? Are they going to give me the same $20 bill that I gave them? No, they're not. Why aren't they going to do it? Because it's in motion. They're constantly keeping it in motion. So banks don't let money sit and compound, do they? How much money does a grocery store make if groceries are compounding on the shelf if nobody's buying them? Zero. How much money does a car dealer make if nobody's buying cars and cars are sitting on the lot? Zero. How much money do you make in your business if things are just sitting and nobody's buying them? How much does like Apple make if nobody's buying computers or iPhone? How much money does the airline make if nobody's flying? How much money does the hotel make if nobody's checking in or checking out? How much money do you make in the housing or the real estate business if things aren't constantly in motion? Zero, zero, zero. So not one business in the world actually uses compound interest. Isn't it a little strange that all the major institutions, banks, Wall Street, mutual funds, insurance companies, they all tell you to park your money and let it sit and compound, but they don't do it themselves? Isn't that a little strange? If it was so good to let the money sit and compound, why aren't they doing it themselves? I'm just trying to get you to think about what's going on. So let's go one step deeper. Who in here has an IRA or 401k or a qualified plan? A lot of you. The reason you have an IRA, 401k or qualified plan is because that's what you were taught to do. It's what your parents taught you, your grandparents, your friends, and your colleagues or coworkers, right? Because the reason that you're putting money in a 401k, an IRA, or qualified plan is because you want to be able to get more money later. Well, let me ask you the question. Is there any guarantees that those dollars are going to be there down the road in your 401k, IRA, or qualified plan? Are there any guarantees? The answer is, well, no, actually, there is one guarantee. All right, that qualified plan is never, that qualified plan is guaranteed to never go below zero. But how exciting would that be if that actually happened? Wouldn't that suck? And who's controlling that money? Is it you or somebody else? Somebody else is controlling the money. And how long do you have to wait to get the money out without paying the penalty? That's right, age 59 and a half. So there's no guarantees. There's somebody else controlling it, and you have to let the money sit there until you're age 59 and a half without paying the penalty. You see, even when you go get the money, the tax is always going to be there on the money, no matter when you get it. Why would you do that? Why would you let somebody else control your money and it has no guarantees? I'm sure a lot of you right now that are putting money into those plans, you have use for that money. Maybe you have credit card debt. Maybe you have a house payment or a car payment. Maybe you want to go out and get involved in some investments. You could use that money right now. Why would you give up control of that money? I know that's what we're programmed to do. Let me ask you a few things. Okay. First of all, let me ask you this. I want you to tell me every single thing you know about your retirement account, your 401k, your IRA, your qualified plan. Tell me everything you know about that account. Wait, hang on. Don't tell me. I'll tell you what you know. Here's what you know. The thing you know is if that account goes up or down based on the quarterly statement that you get. And you may know if those dollars are invested in a low, moderate, or high risk category. But other than that, you guys don't know crap about that plan that you're in. Let me ask you one final question. How many people, I want you to think of everybody that you know at retirement age. Think of everybody you know, and it might even be you. How many people have you ever met at retirement age that are totally happy, ecstatic, delighted, joyful, thrilled about how their 401k, IRA, qualified plan has performed for them? Probably none of you or very few of you, because all of you, every one of you on this call, you all know people at retirement age that are out there in the workforce working, not because they want to be working, because they have to be working, because their 401k, their IRA, their qualified plan did not perform as expected. I'm just trying to get you to think about what's going on. Let's go a little deeper. Let me ask you a few questions. Is a dollar worth more today or in the future? That's right, today. If you ever forget that, think about how many candy bars you could buy 25 years ago for $1, how many you could buy today for $1. Are taxes going to go up or go down? That's right, they're going to go up. Even if taxes don't go up, aren't we taxed on additional items all of the time? Absolutely. So even though taxes have constantly gone up for the last 80 plus years, even if they don't go up, we're taxed on additional items all the time. And if you have a choice to pay tax on the small amount the seed or the large amount the harvest, which one would you rather pay tax on? That's right, the seed. I agree with all three of those answers. But by you putting money in a 401k, IRA, or qualified plan, you are violating every one of these answers, because what you're doing is you're giving up good dollars today to get paid with non-guaranteed dollars in the future. Remember, non-guaranteed dollars, because that money is not guaranteed. You're compounding the tax because the tax is always going to be there. And when you do pay the tax, you're going to pay it on the larger amount and not the smaller amount. Just trying to get you to think about what's going on. One more thing, and I'll leave this topic. Remember what we said? We said money is a means of exchange, which means money equals food. Food is money. Car is money. Money is car. House is money. Money is house. So let's say we all just go out. So all of us go out after this event tonight. And the thing we're going to do is we're going to go to the grocery store and we're going to buy a loaf of bread and a gallon of milk. Are you going to buy that bread, buy that milk, and are you going to wait 5, 10, 15, 20 years to eat the bread or drink the milk? No, man, that would be ridiculous, wouldn't it? How about if we go out tonight and buy a car or a house? Are you going to wait 5, 10, 20 years or even longer to drive the car or move in the house? That would be crazy. Well, then why are you doing that with your money? You see, all those things equal money, do they not? You see, people do things with money that they would never do with things that money buys. You would never buy a loaf of bread, put it in the freezer and wait 10, 15, 20 years to eat it, but you'll put money into a 401k, an IRA, a qualified plan, and hope to get the money 5, 10, 15, 20 years or even longer. I'm just trying to get you to think about what's going on. Oh, but wait, you guys tell me, you say, Brent, but I'm that special snowflake. I have one of those really, really good 401k, IRA qualified plans, and I get a match whenever I put money in there. Well, let me ask you this question. How on earth can the match be guaranteed if the principal isn't guaranteed? But let's just go with your theory and just say that you get a match. So what that means, and I'll just call it a one-to-one match. So we said food is money, money is food. So what that would mean is we would go buy a loaf of bread, bring the bread home, put the bread in the freezer, and then 5, 10, 15, 20 years or even longer, we're going to open up the freezer and guess what's in there? 2 loaves of bread. How much better is that second loaf of bread going to taste? That is right. It's still going to be freezer burned. Just trying to get you to think about what's going on. Okay, let's move on. Now we're going to talk about how a bank works. Make sure you write the questions down. Don't try to keep them in your head because you'll forget them. A short pencil is better than a long memory. So write the questions down. So let's go talk about how a bank works. This is how your bank works. I don't care if you bank at a big bank that we all know the name of, or if it's a small little bank in a small town. I'm going to say that you have $100,000 of your money. Don't get wrapped up in the number. It could be $1 or it could be $1 million. The point I want you to get is that it's your money. And the thing that you do is you put your money into the bank. Now, remember that I'm going to say that you found a really, really good bank that's going to pay you 4% interest on the money that you leave there. So whenever you put money into the bank's going to pay you 4%. Now, I know they're not going to pay you 4%, but you found a really, really good bank. So every time you put your money into that bank, that money becomes a liability to the bank because they owe you interest. So how does the bank take your money and turn it into an asset? The way a bank turns your money into an asset is they loan it out, right? That's what banks do. That's what they're in the business for. They loan money. Banks lend money. So here's what happens. You put your money into the bank, and guess what you do? Almost every one of you on this call have either done or will do in the future, including myself. The thing you did is you went to the bank to borrow money to buy a house, right? I'm sure a lot of you have done that. So let's just call that interest that they're going to charge you on the house loan is 7%. Don't get caught up in the numbers. I want you to get the concept. So so here's what happened. These dollars are your money. You're the depositor. You put money into the bank. The bank's going to pay you 4%. Now what they're going to do is they're going to loan you or somebody else the money you, the depositor, put in there to go borrow to buy a house. And they're going to charge 7%. If you or somebody borrows money from a bank to buy a house, are you expected to pay them back with interest? And the answer is yes. So who's in control of that transaction? The bank. What about a car? Who in here, besides myself, has ever went to a bank to borrow money to buy a car? Let's just call that 8%. Well, if you borrow money from a bank to buy a car, you have to pay them back with interest. Who's in control of that transaction? The bank. What about a house remodel? Maybe you want to do a new swimming pool, granite countertops, a basement, right? You want to add a new patio or a deck. You want to get a home equity line of credit. Let's call that 9%. If you borrow money from the bank, you have to pay the bank back with interest. So who's in control of that transaction? So I hope you see here, ladies and gentlemen, boys and girls, all banks do is they move money in, move it out. Move it in, move it out, move it in, move it out. That's why that $20 bill that I have highlighted with my initials on it is no longer at the bank if I go down there a half an hour after I drop it off to get that same $20 bill, because the money is staying in motion. Okay, finally, let's do a debt consolidation loan, pay off all the credit cards, call that 12%. Well, if you borrow the money from the bank, you have to pay the bank back with interest. So who's in control of every one of these transactions? That's right, the bank. Now let's do a little math. Let's see how well you did and how well the bank did, okay? Remember, I said you found a good bank, and that bank is going to pay you 4% interest on the money that you're leaving there. So now what the bank does is they either loan you or somebody else the money to buy a house at 7%. So the bank made 7 and you made 4. The bank made 7 and you made 4. How much more did the bank make than you? 3%. 7 minus 4 is 3. So now the bank made 8 on the car, but they paid you 4. So 8 minus 4 is 4. On the house remodel, they made 9. 9 minus 4 is 5. And then finally, 12 minus 4, now they get a little harder. 12 minus 4 is 8. So the bank made 20% and you made 4%. The bank made $20 and you made $4. How much more did the bank make than you? If they made 20 and you made 4, how much more did they make? And I see a lot of you guys are saying 16%. Close. What about 500%? That's right. Banks are making between 400 and 1,300% on the money that you leave there each and every day. Because look, if you made $4 and they made $20, didn't they make 5 times the amount of money that you made? Absolutely. So you're probably thinking, well, Brent, how do I really know that's true? How do I know banks make 400 to 1,300% on the money I leave there? Well, here's how you can check that out. You can go get a report. It's called BauerFinancial.com, B-A-U-E-R, BauerFinancial.com. And what you can do is you can get the annual report from any bank that you want, a big bank that we all know the name of, or a little small town bank. And I don't care if you get the annual report from this year, last year, 10 years ago, 20 years ago, you will see on that annual report that banks make no less than 400% annually on the money that you leave there each and every year. If you think about it, it makes sense, right? Because I don't care where you live. You can live in a small town or a big town. We all can get in a car. We can drive down the thing we can do is drive downtown to our main town of wherever we live, and we get to a stoplight. And at that stoplight, there's 4 corners. And tell me what at least one building is that you see on one of those corners on almost every major intersection. That's right, it's a bank. And are the banks on the bad property, the rundown location, bad architecture, bad landscaping, or are they the nicest buildings in town? That's right, they're the nicest buildings in town, and they're everywhere, are they not? I mean, just think about your neighborhood, small town or big town. Whenever you're driving down the road, you see banks everywhere. And every time you see a new building coming up, you're wondering, oh my gosh, I wonder what that's going to be. A new specialty shop, a restaurant, and you drive by 2 or 3 weeks later, and what is it? Another bank. Who do you think is paying for all of those banks? We are. Who's in control of every one of these transactions? The bank. How much risk did the bank take to do all of this? All of these loans. How much risk did the bank take? They really didn't take a lot of risk, because whose money did they use? They used your money, so they really didn't take much risk. Now, I will agree that interest rate offsets risk. So the higher you are as a risk as a borrower, that means the higher interest rate you are going to pay for a loan. But if you're too high of a risk, is the bank going to loan you the money anyway? No. All I want you to do, ladies and gentlemen, and boys and girls, is I want you to be the banker in your own life because you're already doing this. You are already doing all of this in your life. What you're buying houses, you're buying cars, you're maybe doing house remodels, you're using credit card. Who is getting all of your money? Have you ever wondered where the hell all of your money goes to? What we want you to do is start keeping money in your family, recycling and recapturing that money. And all we're doing is we're adding one step in your financial life. All you're going to do is put money into this whole life policy, and you're going to use that money to buy the things in life that you're buying anyway. There you go. There's my resource, BauerFinancial.com. I challenge you. Go look up any bank that you want. I would just start with the one that you bank with. I would get the annual report from any year you want to get it from. And if you find a bank that makes less than 400% annually on the money you leave there, then you owe it to me to share with me what that bank is, and I will change my presentation. I've been teaching this now for 11 years and 3 months. And I've used this same slide for 11 years and 3 months. And I've asked the question every time for somebody in the audience to show me a bank that makes less. Nobody's been able to show it to me yet, but maybe this group will be the first. Let's move on. I'm going to skip this section right here. Any part that I skip, I will show you how you can go back and watch it later. Now what we're going to do is we're going to get into the fun stuff. What I'm going to do now is I'm going to show you how to get all the money back for all the cars you're going to buy, drive, and own for the rest of your life. So not only do you buy the car, but you're also able to get the money back too. How cool would that be? How cool would it be knowing now that every car you buy for you and your family, not only do you get the car, but you also get the money back. And if you can do that with a car, guess what else you can do it with? You can do it with anything that you're buying, any product or service at all. Now, remember the machine that we're going to use to build, keep, and create wealth. The machine that we're going to use is a whole life policy in a mutual company that pays dividends. Why are we using that? Because there's no better tool on this planet that has these features and benefits that allows you to do this. And if you know of something better, please let me know what it is, because remember, I first heard about this in 2006. So that was about 17 years ago. And nobody has been able to show me another tool, another vehicle with these features and benefits that works like this does. But if there's something better, maybe I'm missing something. And maybe if you can show me what that is, I'll stop teaching this and start teaching what you show me. Remember, the policy, it's not any type of policy. It is a specifically designed, specially engineered whole life policy in a mutual company that pays dividends. That's right. It's not a VUL. It's not an IUL. It's not a term policy. It is a whole life policy in a mutual company that pays dividends. Okay. Don't let people tell you that you can do this with an IUL. It simply does not work. And if somebody ever tells you that you can do this with an IUL, here's what you ask them. I want to see the illustration of an IUL policy, and I want you to show me where that IUL policy will never, ever lose value. You will never, ever see that. If you look at the guaranteed side of any IUL policy, every single IUL policy in existence on the IUL side, on the guaranteed side, eventually your cash value can go to zero, your loan availability can go to zero, and your death benefit can go to zero because the cost of insurance can simply not keep up with the policy. It just can't happen. I talk to clients every week that have taken a bloodbath in their IUL policies. Now, look, I could sell you an IUL policy and I could make a very pretty commission on that IUL policy, but I would never, ever, ever sell you one because I would never buy one myself because it doesn't work for this concept. So here's what I tell people. If you really, really, really want an IUL policy, then the thing you do is you put money into your whole life policy with a guaranteed cash value. Now, remember, a whole life policy, it has guaranteed cash value growth, guaranteed growth in the loan availability, and guaranteed death benefit growth. It can never, ever go down. Every day is better than the day before. Today's better than yesterday. Tomorrow's better than today. That's not me telling you that. That is in the insurance contract. But if you really, really are convinced that you have to have an IUL policy, no problem. I'm not saying they're bad. It's just know that it comes with risk. A whole life policy comes with zero risk. Okay. So the thing I tell you is put money into your whole life policy, take a loan from your whole life policy, and now go buy an IUL policy as an investment. All right. But the investment comes with risk. The definition of an investment is something that can go up and something that can go down. See, a whole life policy, even though a lot of people think it's an investment, it's really not, because a whole life policy can never go down in value. It can only increase. And the definition of investment is something that can go up and can go down. So use your whole life policy exactly the way that I do to go and fund all of my investment. Now, in this policy, the thing you have to do is you have to pay a premium. But the good news is that you get to choose the premium amount that you put in. I have over 7,000 clients in every state of the country. I have never told anybody. And if there are clients on right now that are clients of the Money Multiplier, in the chat box or Q&A, I don't know, I'm not sure which box to put it in, have any of us on the Money Multiplier team ever told you how much money to put in your policy? And I would guess the answer is no. Now, maybe you've asked for some help, but we've never told you how much to put in. You decide the amount to put in, and you decide how often you want to put it in, whether it's monthly, quarterly, twice a year, annually. And you can always change the mode of how you're putting it in. And you can also always lower the amount by at least 60% that you're putting in. And as time goes on, you could even lower it where it comes down even lower than that. Now, not that you would ever want to do that, right? Not that you would ever want to lower it. The only way you would ever want to lower your premium is if you have a severe financial catastrophe or disaster, and it happens in the first 2 years of the policy. But other than that, you would never want to lower it. Okay, time out for a drink. A premium is a payment, right? I mean, I get it. We get it in the mail and we got to pay a payment. But if you notice on the screen, I say a premium is a deposit. Well, it's really a payment. However, if you put money into an account and you have immediate cash value, and remember my definition of immediate is within 30 days, is that money now treated more like a payment or a deposit? That's right, a deposit. And tell me what word you like better, payment or deposit? Deposit. Have you ever made too many deposits in your bank account? No. So in your mind, you have to think of this as a deposit. I know it's a payment, but you have to kind of do a paradigm shift and think of the premium as a deposit. Now, age doesn't matter and death benefit doesn't matter. That's right. We are not sitting here today talking about life insurance and death benefit. Although you have life insurance, you do have a death benefit, so that's a bonus. That's the bingo. That's the icing on the cake, the cherry on the icing. But the reason that we're doing this is for cash value. Now, as I blow this screen up, I want you to look here at this cash value column. That's why we're working together. You're not coming to us at the Money Multiplier to buy a policy for death benefit and life insurance. I mean, yeah, that's a great extra bonus, right? That's like going to your fast food restaurant and all you do is order an a la carte double cheeseburger and they end up giving you like fries and soda just because they made a mistake. You get extra, right? So that's a good thing. I guess probably not good for your arteries, but I mean, it's a good thing, I guess, right? So what we're doing is we're focusing on the cash value. Now, in this particular instance, the premium deposit that this individual is going to put into this policy is $10,000 a year. Don't get wrapped up in the number. If 10,000 is too much, then take off a zero. If it's too little, add a zero or times it by 2. Again, we're not going to tell you the amount of premium to put into the policy. You are going to make the decision. There's lots of columns on this screen. The one on the left is just policy year. Year 1 to 8, 9 to 13. All it is time. And then you have age and death benefit. Now, remember, I told you not to worry about age and death benefit, and that's why these columns are grayed out. Okay? So don't even worry about age and death benefit. Okay? We're talking about cash value. Okay, I get it. There's 2 or 3 of you on the line that are totally analytical, and you have to know about age and death benefit, or you will not hear anything else I say. So let me go over it quickly. Let's say we have 3 people. They're all in equal health, but they're different ages. You pick the ages, 20, 40, 60, 30, 50, 70. They all walk into the same life insurance store on the same day. They're all in equal health. They're going to put $10,000 into their policy. Who's going to have the most death benefit out of those 3 people? That's right, the younger person. Who's going to have the least? The oldest person. That just makes sense, right? However, we're not doing this for age and death benefit. We're doing it for cash. So let me now use this example. We have 3 people. They walk into the same grocery store at the same time. They each have a $20 bill. They're different ages, 10, 20, 30, 20, 40, 60, 30, 50, 70. They all have $20 in their pocket. Who's going to be able to buy the most groceries out of all of those 3 people? That's right. Everybody will buy the same amount because age and health does not matter when we're talking about cash. Right? It doesn't matter the color of your skin. It doesn't matter the language you speak. It doesn't matter how old you are. It doesn't matter how good you look, how well you're dressed. The same $20 buys the same amount of groceries for all 3 of those people. So, does age and health affect the cash value of your policy? The answer is no. And I'm driving that point home because somebody is going to put in the chat box or ask the question live at the end of this. They're going to say, Brent, this is great information, but I'm too old to do it. No, man, you're not too old to do it. The only difference is that you are not going to have as much death benefit as the younger person. Or let's say you're not even insurable. Let's say you just had 7 feet of your intestines removed, or God forbid you were diagnosed with cancer and you can't even get a policy. Well, that's okay. You can buy a policy on somebody else that you have a vested interest in, and you can own and control every aspect, every function of that policy. For example, you could buy a policy on a spouse, a child, a grandchild, a niece, a nephew, somebody you have a business relationship with. We have many, many, many people on our team that are not insurable for a health reason or another reason that still own policies. They just don't own them on their bodies. They own them on somebody else they have a vested interest in, and they control every aspect or function in the policy. And this individual is going to put in $10,000 a year into this policy. He's going to pay it for 7 years. At the end of the 3rd year, beginning of the 4th year, he's going to go buy a $25,000 car. Okay? A $25,000 car. Now, in real life, I would never have you wait till the end of the third year, beginning of the fourth year to buy the car. I want you to start using the cash value immediately. How soon is immediately? Within 30 days. Okay. So as you see here in line 1 and the cash value available, you have immediate cash value to use. But in this case, I'm going to wait to the end of the third year, beginning of the fourth year. Now, the thing you have to trust me on this, just know the earlier you start using the cash in your policy and play honest banker with yourself, the bigger the numbers are going to get. You just have to trust me on that. All right. So in this case, he's going to wait to the end of the third year, beginning of the fourth year to go out and buy that $25,000 car. He's now going to pay himself back with interest. He borrowed $25,000. So he's going to pay himself back $500 a month or $6,000 a year for a period of 5 years. Okay. So he's borrowed 25, paid back 30. Now, let me ask you this question. If you borrow money from yourself, is it a good idea that you pay yourself back with interest? Absolutely. It's a great idea. But do you guys ever do it? No, you never, ever do it. See, I don't even know you guys, and I know what you do. The thing you do is you put money in the bank, and then anytime there's something you want to buy, you go take the money out of the bank, you buy the crap that you want to buy, and you never, ever, ever even have a plan to pay yourself back, much less pay yourself back with interest. Well, what if you borrow money from a bank? Do you pay them back with interest? Absolutely you do. And you never skip a beat, because if you don't pay the bank back, they'll come and repossess your crap that you bought. They'll foreclose on your stuff. So here's what you have to do, ladies and gentlemen, boys and girls. From here on out, every time you borrow money from yourself, you have to pay yourself back with interest, because if you don't, you're saying your money is not as valuable as the bank's money. So treat your money the same way you would treat a bank's money. All right. So let's see what we did here in 8 years. In 8 years, we put in 10 times 7 is 70, 6 times 5 is 30 for a total of $100,000. Okay. But the thing we did is we took out 25 to buy the car. So if I put in 100 and took out 25, if I put in 100 and took out 25, how much more did I put in than I took out? The answer is 75,000. So my net injection is 75,000. How much cash do I have in the policy in the 8th year? That's right, 73,226. If you take 73,226 divided into 75,000, that means you just got back 96% or 96 cents of every dollar for that car that you just bought. How would you like to have 96 cents back out of every dollar for every car you've bought, driven, and owned, or every car you're going to continue to buy, drive, and own? Because let me ask you this question. Out of all of the cars you and your family have bought and purchased up to this point in your life, how much of the money do you have today? Here's a hint. 0. So if I do nothing else but show you how to get part or all the money back, has it been a good evening? Now, let me ask you this. Are you still driving the first car that you ever bought? No, you're not, probably, unless you're really young, right? You probably aren't even driving your second car, maybe your third car or your fourth car. And you're going to continue to go through life and buy and drive cars. Out of all of the cars that you've bought, driven, and owned, are going to continue to buy, drive, and own, you've got 0, 0, 0 of those dollars back. So all we're doing is adding one step in our financial life. We're just buying a life insurance policy that has immediate cash value, and we're going to use it to buy the car. That's all we're doing. You're going to buy the car anyway. You will buy the car anyway. We're just adding this one step. Okay, now watch this. I want you to look at year 9 to 13. Now we're going to go buy a second car, because that first car wore out, or you're tired of it, or maybe you're married and your spouse is tired of walking for the last 5 years, and your spouse wants a car of their own. So now we're going to go buy a second car in year 9 for $25,000. Where is the money coming from? it's coming from the 73,226. I'm no longer putting premium in the policy in this example. In real life, you would never want to do that, but I just want to isolate the car purchases in this presentation. So I'm going to say you're no longer putting premium in the policy. All we're going to do is borrow the $25,000 out for the second car, and we're going to pay ourselves back with interest, just like we did on the first car, $500 a month, $6,000 a year for 5 years, which is a total of $30,000. So again, let's look at year 9 to 13. The thing we did is took out 25 to buy the car. We paid back 30. Took out 25, paid back 30. How much more did we put back than we took out? Well, if I took out 25, put back 30, my true net injection is $5,000. Are you with me? How much cash do we now have in the policy in year 13? That's right, 95,000 and some change. So our cash value grew between year 8 and year 13. It grew from 73 to 95. That is a $22,000 growth with a $5,000 net injection. How do you like buying cars my way? Is there anything stupid, ridiculous, or idiotic that I'm doing? No, man. All I did is I bought a stupid ass life insurance policy and I'm using it to buy the car. You see, you're going to buy the car anyway. We're only adding one step in our financial life. Now, I know what a couple of you are thinking. You're thinking, Brent, why did you just use the word ass? That wasn't very nice. Well, because you see, I can see you guys, and a couple of you are not paying attention. A couple of you are texting. There's somebody watching TV. Somebody's washing the dishes, and someone else is burping the baby. But ever since I used the word ass, you put all that other stuff down and you're focused now with me on the screen. I don't know what it is, but the word ass just brings your attention right back up to the screen. So thank you for that. Let's see what we did in 13 years. Now, I want you to think about how fast the last 13 years has went in your life. I'm getting close to 56 years old. It just seems like yesterday I was 43. So 13 years goes by pretty quick. Let's see what we did in this example in 13 years. In year 1 to 8, I put in 10 times 7 is 70, plus 6 times 5 is 30 for a total of 100,000. And then in year 9 to 13, I put in 6 times 5 is 30. So I put in 130,000, but I took out to buy 2 cars, 25 in year 4, 25 in year 9 for a total of 50. So I put in 130, took out 50. Put in 130, took out 50. So how much more did I put in that I took out? Well, 130 minus 50 is 80. So my true net injection is $80,000. How much cash is in my policy? That's right. It's okay to say it. 95,000. So wait a minute. Are you telling me, are you saying that I put in 130,000, I took out 50 to buy the cars, so my net injection is 80, and here I am in the 13th year with 95,000 in cash? And if that's true, which it is, how much do those cars cost you to buy, drive, and own? So the way my simple chiropractic mind thinks is if my net injection was 80 and I've got 95, I made money on those cars. Not only do you have 95,000 in cash, guess what else you have? You have 2 cars on your driveway. You have a 5-year-old car and a 10-year-old car that you've owned, driven, and used the entire time. You can continue to own the car, drive the car, use the car. You can sell the car, donate the car, do whatever you want. So, did I just show you how to get all the money back on all the cars you're going to buy, drive, and own for the rest of your life? If I can do this with a $25,000 car, tell me, could I do it with a $50,000 car? Let's say if I change that number to 25, from 25 and made it 50,000, and instead of paying myself $6,000 a year, I'm paying myself $12,000 a year. What would happen to the number? They would just go higher. How about if mama and daddy had a $50,000 car? What would happen to the number? They would get bigger. If I can do this with a car, can I do it for anything at all? Do this for a bicycle? Could I do it for a boat? Could I do it for a house? Could I do it for my taxes? That's right. Could I pay my state, federal, local taxes and get all of the money back? Absolutely. Could I do it for charitable giving? Could I give to charity and get all the money back? Oh, Brent, that ain't right, man. God does not want you to get your charitable giving back. Well, let me just tell you, if God did not want you to get your charitable giving back, he would not have me on this webinar teaching you how to do it, and he would not have you on the webinar learning how to get all your money back. Now, Woody, as a matter of fact, is there anybody that you know that has added wings to any churches that has no money? No. It doesn't matter what it is. We're turning every liability into an asset, every depreciating asset into an appreciating asset. Have you ever heard of a guy named Robert Kiyosaki? Robert Kiyosaki wrote a book called Rich Dad, Poor Dad. That's what he's famous for. He also wrote another book called Second Chance. In that book, Second Chance, this is exactly what Robert Kiyosaki talks about. He explains this concept. But when you guys read the book, you did not understand what it meant because they make it too difficult to understand. Have you ever heard of a guy named Tony Robbins? Tony Robbins, he wrote a book called Money Master the Game. In chapter 5.4 of that Tony Robbins book, this is exactly what Tony Robbins talks about. But again, they make it too difficult and too complicated to understand, and you read right through it and didn't know what it meant. Now, earlier, I told you that basically you got all the money back for all the cars you're going to buy, drive, and own for the rest of your life. And did this policy really cost you anything? Well, I say no, but let's go back up here and I want you to look at year one. In the very first year, when you put in 10,000, the whole 10,000 was not available to use, right? But that's okay. Are you in this for the short term or the long term? You tell me long term, but we tend to get hung up in short term thinking. Have you ever read a book called A Purpose-Driven Life by Rick Warren? In that book, Rick Warren says, it doesn't matter where you start, it only matters where you finish. And this is the game of life. There are 3 rules that you have to follow that are important. Rule number 1, I want you to look at policy premium deposit. You have to pay yourself first. Pay yourself first. Now, I sit here and tell you to pay yourself first, and you all say, I've heard about that before, pay yourself first, but do you ever do it? No, you never do it. See, I don't even know you, and here's what you do. Every time you get money, I don't care if it's active income, passive income, investment income, every time that money comes in, you put that money into somebody else's bank account and you go out and buy the crap that you want, right? So the thing that you do is you pay the house payment, the car payment, you pay the electric, the food, the travel, the entertainment, you pay for Bobby's soccer practice, Susie's piano lessons, your charitable giving, and you hope there's money left over for you. You have to pay yourself first. Pay yourself first and then pay other people. Rule number 2, pay yourself with interest. Treat your money the same way you would treat a bank's money. If you don't, you're saying your money is not as valuable as the bank's money. And rule number 3, recycle and recapture all of the money that you're sending out to others. Because see, guys, if you use this concept and you use this system, there is no money being leaked out to other people. Everything is in a closed system. That money is staying within your family. Okay, 3 rules. Pay yourself first, pay yourself with interest, recycle and recapture. If it works for a car, what else?
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you, privatemoneyclub.com. Back to you, Chris.
2 other resources I gave you. So this is book number 4. I've given you 4 books now that you have to add to your wealth building library. Okay. The third one is The Second Chance by Robert Kiyosaki, and then Tony Robbins' Money Master the Game. The next thing we're going to talk about is the Money Multiplier map. Now, we design these maps for you. Now, at this point, you're probably thinking, hey, Brent, this all looks pretty cool and I would like to do this, but there's got to be a charge. There's got to be something. How do you get paid to set this policy up for me? Well, great question. I'm glad you asked. You are never going to write me a check or our company, the Money Multiplier, a check for a dime. Okay. We are going to be the ones that do your policy. We work with several different insurance companies. No matter who you buy a policy from, somebody has to be your agent. The reason you want to do it with us and not your brother-in-law that sells life insurance is because your brother-in-law has no clue how to do this whatsoever. And if he did understand, why hasn't he told you already? So the way that we get paid the same way your car insurance guy or gal gets paid. For example, if you go to John Smith, the Allstate man, to buy car insurance, the check that you write is not to John Smith. You write the check to Allstate, and Allstate pays John Smith a commission. So you are not going to pay us at all. The commission that I get paid is not determined by you, and it's not determined by me. It's determined by the insurance company. The reason you want to use us is because this is all we do. We are 100% the infinite banking concept. And even if you go to your brother-in-law or whoever that sells life insurance and you say, hey, man, I watched this presentation and they told me about this R. Nelson Nash guy becoming your own bank. So that other agent says, oh, yeah, I know all about that. I can design your policy that way. Well, number one, if they knew how to do it, why haven't they told you about it? But let's just go a step deeper. If they really know how to do it, ask them these questions. Number one, ask them to show you how you can make money, all day long by borrowing at a higher rate than what you're earning. They're not going to be able to show you. They don't have a clue. Number two, ask them to show you how you're going to recycle and recapture and get all the money back for all the cars or any product or service you're going to buy for the rest of your life. They have no clue. And number three, have them show you how to design this money multiplier map for you. They have no clue. And this is what our team does for you. This map that I'm about to show you, our team designs this map for you, not just one map. They're going to update that map for you every 4 to 6 months, 2 to 3 times a year. They're going to update that map for you. That is a service that we provide you. And why do you need that map updated? Because your financial life is constantly changing. Wherever you're at today in your financial life is not where you were 1, 5, and 10 years ago. And it's not going to be where you're at 1, 5, and 10 years from now, because you're going to go through your financial life and you're going to buy things, sell things, windfalls, downfalls, raises, demotions, just like you've been doing your whole life. So that is a service that we provide for you on an ongoing basis. There's no hidden cost, extra charges, extra fees. It's not like that IUL policy where after a certain time, in order to keep it alive, you got to dump a boatload of more money into it in order to even keep it alive. It's not that at all. No, remember, this is a specifically designed whole life policy in a mutual company that pays dividends. All right. Now, remember earlier, I told you that I had $984,711 in debt, and I paid it off in 39 months. After I go through this example, you're going to see how I did that. Okay. I'm not going to use my exact example. I'm going to use a simpler example, but you'll understand. This individual, it's a real life example. It's a chiropractor from the state of Minnesota. This individual, he came and he showed up at our doorstep and he owed these 12 third-party debts. Okay. I'll read them across, across the debts. So the first several are credit cards. He owed Discover, Chase, American Express, Barclays, Lowe's, Nordstrom's, Wells Fargo. Those are all credit cards. He had a private loan, BMW, West Marine for a boat, a condo, and a house. In each of those columns, it shows you how much he owed, it shows you his minimum monthly payment, his interest rate, and how long he had left to pay on them. If you add them up left to right, it comes up to almost $470,000. So, but remember, I like to underpromise and overdeliver. So I want you to write down on your paper that he owes $450,000. Now, go over to the left and look at premium deposit. He's going to put in $25,000 a year into his policy. That's his number. Remember the last guy on the last example put in 10,000. This person's putting in 25,000. You decide the amount of premium that you want to put in the policy. And remember, you can pay the policy monthly, quarterly, twice a year, annually. You can change the mode. You can always lower the amount. It's up to you. So on your paper, you should have written down that he owes $450,000. You should also have written down that he's going to put in $25,000 a year to pay down that $450,000 in debt. Now, let's assume there's no interest on the debt, which there is, but let's assume there's not. How long is it going to take to pay off $450,000 at $25,000 a year? That would be 18 years. 25 goes into 450, 18 years. So on your paper, he has $450,000 to pay off. He's putting in $25,000 a year. It should take him 18 years to do it. Let's walk through it and see how he does. On the left, all the way on the left column, all it is time. Year one, we have policy month, 1 to 12, 13 to 24, and so on. The premium deposit is $25,000. So the thing he does is in the first month, he puts in $25,000 into the policy. He immediately, how soon is immediately? Within 30 days, he's going to borrow $14,300, and he's going to take that money and he's going to use it to pay down the debt. So here's what he does. He takes that $14,300, he pays off all of Discover, all of Chase, all of American Express, all of Barclays, and he pays Lowe's down from $9,500 to $7,600. He takes the money that he was paying the first four creditors. Discover is $160 a month, Chase is $200, American Express is $200, Barclays is $228. He takes that money that he was paying them, and now he's going to pay himself back into his own bank account, which I have labeled as miscellaneous account, which is a total of $788. So all he was doing before was paying the creditors, but now that he's paid them off, he's paying himself back the money. Now, by him doing this, is he changing his cash flow? Is he working any harder, taking any additional risk, or losing control? No, he's only changing who gets the money. That's it. Everything stays the same. Now, remember, that money that you pay yourself back, that money is yours to use right away again, right? It's actually used right away again, not 30 days, immediately. You can use that money. So he continues to pay himself back. We get to the end of the first year, beginning of the second year, month number 13. He now puts in $25,000 again, and now he's able to borrow a larger amount than he was the previous year. He can borrow $14,800. So he takes that $14,800. How soon can he borrow that? Within 30 days. He takes the $14,800. He adds the $9,400 that he's been paying himself back the previous 12 months, and he has a total of $24,300. He takes that $24,300. He pays off Lowe's. He pays off all of Nordstrom's. He pays off all of Wells Fargo, and he pays off the BMW from $17,000 to $15,000. He takes that money that he was paying those third-party creditors, which is $287 a month to Lowe's, $276 to Nordstrom's, $271 to Wells Fargo. He adds that to the $788 he was paying himself back, and now he pays himself back $1,622 a month. Is he working any harder, changing his cash flow, taking any additional risk, or losing control? No, man. All he's done is added one step in his financial life. All right. Now, if you notice on the private loan, and if you go down there to month 18, the private loan only had 7 months left to pay. So that loan pays off during the normal course of the loan. So now what that does is it frees up $922 a month. So here's what he says. He says, hey, man, I've been paying the $922 a month for quite a while. I'm used to paying the $922 a month. So I'm going to continue to pay myself back that $922 a month. So what he does is he just adds the $922, adds it over to the miscellaneous account. $922 plus $1,622 is $2,544. He doesn't have to do that. I mean, he could choose not to pay himself back. It's totally up to him. He's in totally control. But he said, I'm used to paying it. I'm just going to continue to pay it. Now we get to the end of the second year, the beginning of the third year. Now look what happened. Month 25, we put in $25,000 again. Now look what we can borrow, $22,400. And let me just tell you, this goes back to where I say I underpromise and overdeliver. At this point, you can basically borrow dollar for dollar of what you're putting in. Because see, the policy, the values continue to go up. The loan availability, the cash value, the death benefit, each and every day is better than the day before. Today's better than yesterday. Tomorrow is better than today. That's not me telling you. That is in the policy contract. So now look what we do. We put in 25. We borrow 22. How soon do we borrow that 22? Within 30 days. We also have in our miscellaneous account, the previous 12 months, we've paid ourselves back $25,900. So $25,900 plus $22,400 is $48,300. We take the $48,300, we pay off the BMW. So we add the $500 a month to the $26,444 a month we were previously paying ourselves back in the miscellaneous account. And now we're paying ourselves $3,044 a month. 2 months later, we have enough money to pay off West Marine. So what we do is add the $1,261 to the $3,044, and now we're paying ourselves $4,305 a month. Are we changing our cash flow? Are we working any harder? Are we losing control, taking any additional risk by doing this? No, man. All we've done is added one step in our financial life. We bought this stupid life insurance policy, and we're using it to pay down the debt. You guys are going to pay down the debt anyway. When you do it this way, you're able to recycle and recapture the money. A lot of people ask, they say, well, Brent, don't you think it would make more sense just to take that money and pay the debt off first? Well, no, because if you do that, all that money leaves your family forever. Just think about it. If I've got this $20 bill and I just go pay a debt with the $20 bill, if I give it to the creditor, that money has left my family forever. It is gone. It is gone, gone, gone. It disappears quicker than a fart in a fan factory. It goes quickly. So by putting your money into the policy, that money is staying within a closed system. You are recycling and recapturing all of those dollars. There's no money that's being leaked out to anyone else. I hope you get that, because that is so, so important. Remember, it all comes back to paying yourself first. Pay yourself first. You guys aren't used to doing that. You've heard it. It goes in one ear and out the other, but you never do it. You pay everybody else first and hope there's money left over for you. From here on out, there's no more excuse for you not to pay yourself first. And if there is a better vehicle on this planet to do this with these features and benefits, then go do it with that vehicle. And I hope you call me and tell me what the vehicle is, because for the last 17 years, nobody's been able to show it to me. All right, now watch this. If you've been sleeping up to this point, you have to wake up. This is huge, what I'm about to show you. Let's see what we did in the first 3 years. In the first 3 years, how much did we put into the policy? Well, year 1, 25, year 2, 25, year 3, 25, for a total of 75. Well, okay, 75,000, I agree. How much are we using so far? The first year I used 14 and some change. The second year, 14 and some change. The third year, 22. So we put in 75 and I'm using 50. We put in 75 and I'm using 50. How much is left in your policy? Well, you're thinking, Brent, that's easy. I put in 75. I'm using 50. So 25,000 is my policy. No, no, no. All $75,000 is still in your policy. It's in that policy that is growing at a guaranteed compounded growth rate, tax-free, and the government is completely out of your hair. Because see, here's what's going on, ladies and gentlemen, boys and girls. Every time you put money into the policy and then you take a loan from the policy, you are not borrowing your money. No, no, no. You're simply putting your policy up for collateral and you're taking a loan from the general fund of the insurance company. So your money is continuing to grow as if it was all in there. Uninterrupted compound interest. Go Google that term and see whose face shows up on the first page. And if my face doesn't come on the first page, then you call me and let me know, because I got to have a couple of words with my SEO guy. The money is growing uninterrupted compound growth in a tax-free environment, and the government is completely out of your hair. So what better vehicle on this planet allows you to use your money and it's all continuing to grow as if it was all in there? Tell me another vehicle that has these features and benefits. Nobody's been able to show me one yet. I thought you guys would be a little more excited about that, but that's okay. I know it's getting late. All right. So we continue to pay ourselves back just like we were before. Now we get to the end of the third year, beginning of the fourth year, month number 37. Now look what happens. Now, okay, I want you to look at month 37. We put in 25 grand. How much can we use? About 26,000. So that means from this point on, every time I put money in, I have more money to use than I have more money to use than what I'm putting in. This would be equivalent to me showing up at your driveway, and every time you give me $25, I give you back 26. How many times you want me to show up at your driveway? Constantly, right? So every year, these numbers just continue to get bigger and bigger and bigger. My oldest policy, which I started in 2008, which is 15 years old now, every dollar I put into that thing, it gives me like $2.60 to use. So if I put in $10, it gives me $26. If I put in $100, it gives me $260. If I put in $100,000, it gives me $260,000. And guess what's going to happen to that policy next year? In year 16, I don't know how much it's going to give me, but it's going to give me a number larger than $2.60 for every dollar that I put in, because it's 1 year older, 1 year more efficient. Back to month 37, I have 26,000 plus the 41. I've got 67,000 to use. So I take the 67, I pay down the condo from 81 to 12. I don't pay it off. I don't have enough money. So because I don't pay it off, I continue to pay myself back the same amount I was paying myself back before in the miscellaneous account, which is 4305. Because remember, I said, I don't want you to change your cash flow. I don't want you to work any harder, take any additional risk, or lose control. Finally, at the end of year 4, I pay off the condo. So now when I pay the condo off, it frees up $1,179. I add it to the 4305 I was paying myself back. And now I'm paying myself to the miscellaneous account 5484. But look what else I do in month 49. Now I put in $25,000 into the premium. Well, how much can I use now? 27,000, or at least close enough for government work. So now that means I come back to your driveway a year later. You give me $25. Remember last year I showed up? You gave me 25, I gave you 26. Now you give me 25, I give you 27. Are you liking me a little better this year than last year? I would hope so. Now, all of these numbers aren't made up. No, this is actually in your policy contract and your illustration. So before you ever sign, pay, or accept the policy, you look at these numbers and make sure they're telling you exactly what I'm showing you. So month 49, we have 26,000, almost 27,000 to use. The previous 12 months in the miscellaneous account, we put in 51. So 51 and 26 is 78. So we take the 78 and we pay down our last third-party debt from 181 to 102. All we have left is the house. Now listen, I've already paid off 11 of the 12 third-party debts. Go back to that sheet of paper where I had you write down numbers. And I had you write down numbers. And I asked you, I said, how long is it going to take us to pay off this debt, assuming there's no interest, which there is? And you told me 18 years. Well, here we are at the beginning of the 5th year, month 49, and we've already eliminated 11 of those 12 third-party debts. So do you think we may be a little ahead of schedule? I would think so. All right, let's keep rolling on. Life just goes on, right? I'm not working any harder, changing my cash flow, taking any additional risk. We get to the end of the 5th year, beginning of the 6th year, month 61. We now pay our premium, but how much do we pay in the first premium deposit? Well, we only pay $10,000. How much were we supposed to pay? 25. Well, why are we only paying 10 and not 25? Okay, I'm going to give you a little bonus material, stuff you really don't need to know. But the way we design the policy is we design it for high maximum cash value. And the thing we do is we keep it under this thing called the MEC line, MEC. It's called Modified Endowment Contract. So we design the policy where it has high efficient cash value, and we keep it under the MEC line. So there's 2 parts to this policy. In this example, the total premium was $25,000. So $10,000 or 40% of that money was called base premium. The other $15,000 or 60% is called paid up additions rider. In the beginning stages of your policy, the base premium has 0 or very little cash value. All the cash value is being driven by the paid up additions rider. So now that the policy is older, it's more efficient. In this case, it's 61 months old. Now the paid up additions is no longer as efficient. So what we do is we drop that off. So the paid up additions, which before was equivalent to 60% or 15% on this policy, we drop off that 15,000, and now we're only paying the base premium of 10,000. And now the base premium is driving the cash value. I want you to think of it like this. Have you ever seen the space shuttle take off into space? It has a space shuttle and 2 booster rockets. When that shuttle gets way up into the air, what happens to those booster rockets? They drop off. Why do they drop off? Because it's no longer needed, okay? Same thing with your policy. We're dropping off the part that's no longer needed. So now we're just paying the base premium. But watch what happens now when we put in that 10,000. That 10,000, you immediately have 13,000 to use. Now, I'm not a math genius or anything, but I know if I put $10,000 into something and I immediately, remember the definition of immediately is within the first month, the first 30 days. If I immediately have 13,000, that is a 30% increase on my money. Let me ask you a question. How much of your money do you want growing at 30% 61 months from now? The correct answer is all of it. And if you did not say all of it, you do not need financial counseling. You need severe psychiatric care. And I'm a chiropractor, remember, and you may have what we call a subluxation around C1 and C2, which is the atlas and the axis. And we just may need to clear out that subluxation that you have. Now, what do? We start a second policy. A second policy. If you work with us, you will never wait more than 5 years to start a second policy. Most of you, a lot of you on this call have more than one policy. And if you do, just put in the chat box, I have more than one policy. I currently have 25. I think Chris has, 9 or 10. I think Hannah has 5 or 6. I will just tell you, we have over 7,000 clients in every state of the country. 91% of those clients that have been with us a year or longer have more than one policy. About 70% of those come back to start additional policies before the first year because they see how efficient this process works and how effective that we work with them. So we will never have to call you and ask you to start a second policy. You will know when the right time it is to do. So in this case, he starts a second policy. And if you think about it, a second policy is like another branch office of your bank. All right. I want you to think of wherever you have your checking or your savings account now. Is there one branch or are there multiple banking branches? Yeah, there's multiple banking branches. There's branches all over the place. So can you have multiple branches of your banking system? The answer is yes. All right. Let's see what we did. We can borrow on the first policy, 13,000. The brand new second policy, we can borrow 14 for a total of 27. 27 plus the 65 we've been paying ourselves back in the miscellaneous account for the previous 12 months, we have a total of 93,000. Well, I only owe 90,000 on the last debt, which is the house. So I completely pay off that last creditor. So what I just did, ladies and gentlemen, boys and girls, is I just eliminated all 12 of those third-party debts, almost $470,000 of third-party debt. I eliminated that. How long did I say it was going to take us to do it? 18 years? Nope. It didn't take 18, 15, or 10. We did it in 5 years and 1 month. How happy do you think that family was? Now do you see how I paid off $984,711 in debt in 39 months? That's right. I just went quicker. That's all I did. I just went faster. Let's take a look at this family. Could they have went faster if they wanted to and paid it off quicker? They sure could have. They could have put in more premium. They could have started another policy earlier. They could have paid themselves more back than just the minimum of what they were paying on their minimum payments. Could they have went slower? They sure could have. They could have went slower. They could have started a lower premium, not started a second policy, not paid themselves back. You see, the speed at how you go with this is totally up to you. It doesn't matter how fast you go or how slow you go. There is absolutely no risk to everything that I showed you tonight. Nobody in your state, I don't care what state you live in, nobody in your state has ever lost money in a whole life policy in a mutual company that pays dividends. It's never happened. Go look it up and find it and tell me where it's at. You're not going to be able to find it, right? All we're doing is adding one step in your life. The only risk factor in everything I'm showing you is you. You are the risk factor and the way you act with the policy. And who do you know better than you? All right, now let's peel back the onion a little bit more. How much money did they actually put into the policy to pay off that almost $470,000 in debt? Well, in the first year, they put in 25, the second year, 25, third, fourth, and fifth, 25. That's 125 plus 10 is 135, plus another 25 is 160. So they injected 160 and paid off $470,000 of third-party debt. Let's move on. Almost done. And I know I'm over, but I don't feel good. I'm a little sick, so I'm a little slower, but I'm trying to give you the juice. You're probably thinking, who actually does this? Who does this in our life, right? Why haven't I heard about this before? Well, I was in Denver, Colorado, about to give a talk, and it was on November 16th, 2016, because this is the date of the article, and this is when I looked it up. And I went to ESPN.com because that's a great time for sports scores, right? So cash value life insurance makes Jim Harbaugh college football's top paid coach. So here's what the University of Michigan does. They actually purchased a whole life policy in order to use it to pay the salary of the head coach. So that's right. If you have a business, employees, I work with a lot of chiropractors, dentists, orthodontists, doctors. If you have employees, business owners, why not use a policy to pay your employees? Because the University of Michigan says, hey, not only can I pay the salary of the coach, but I can get all the money back, recycle and recapture those dollars. And if you know anything about college football and the University of Michigan back in 2016, it was a good thing they were getting the money back on this guy because he was not winning the games that he was supposed to be winning back then. He's done a little better lately, but back then, no. Walt Disney, after failing in the pursuit of traditional means of financing, Walt Disney had to provide his own financing. And here's what that means. Walt Disney went to a bank and said, hey, I got this idea. It's called Mickey Mouse and Donald Duck. And they're like, what? That's crazy. We're not going to lend you any money. So a large part of the resources he had to collaterally borrow from his cash value life insurance to start Disneyland. Who knows if Disneyland would ever be in existence if it wasn't for cash value life insurance? Same thing with Ray Kroc and McDonald's. He had to borrow from his 2 cash value life insurance to cover salaries of key employees. And he also used some of that money for an advertising campaign called Ronald McDonald. Have you guys seen Ronald McDonald lately? Where's he at? Pampered Chef, Doris Christopher, in 1980, in her suburban Chicago home, had to borrow $3,000 from her life insurance policy to start this business called Pampered Chef, which she later sold to Warren Buffett for $1.5 billion, billion with a B, dollars. Who knows if Pampered Chef would have ever been a thing if Doris Christopher was not able to borrow the money to start her business from her cash value life policy. There you go. Your president, Joe Biden. This article is 9 years old. Look at the left side of that column. Biden has no stocks, bonds, or savings account. It says Joe Biden has 6 life insurance policies in a mutual company. This article was 9 years ago. Who knows how many policies Joe Biden owns now, 9 years later? I can only imagine how many he owns. Or maybe he doesn't own any at all. Maybe they all belong to Hunter. I usually lose a half a dozen people with the Hunter joke. If you do, I'll see you guys drop off. All right. Everybody doesn't like the Hunter stuff, the Joe Biden, the Hunter stuff. Well, tough. I'm going to still talk about it. All right. Stanford University, same thing. JCPenney, Foster Farms, lots of other examples. Now that you know this information, everybody should be doing this. See, before tonight, all you guys didn't know. Most of you guys had no clue. You knew there was something like this out there, but you didn't know what it was. Now that you know it, everybody should be doing this, because if you don't do this, you are not only stealing from yourself, but your spouse your children, your grandchildren, and future generations to come because you're letting money leave the family. So like, just think about this. All of us have access to the same financial tools. It doesn't matter if you're super wealthy or not wealthy, right? If you're super wealthy or not wealthy, we all have access to the same financial tools. The only difference is the wealthy understand how to use the tools. Now that I understand how to play the game, I'm just playing the game right along with them. I'm not reinventing the wheel. No, remember what I said earlier? This concept is not brand new. It's been around for over 200 years. Go out there and research the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays. Go look and see how they built, kept, and created wealth in their family. All we're going to do is use the same tools that they've been using for over 200 years. Look, so have you guys ever heard of a guy named Warren Buffett? Here's what Warren Buffett said. I don't know when he said it, but I heard it in 2008. Now, I think about this quote every day of my life, and I don't like complicated stuff. I like everything to be simple. I'm not complicated at all. And here's what Warren Buffett said. Warren Buffett said this. He said, if poor people would just start doing what rich people do, they wouldn't be poor anymore. How much sense does that make? All we're going to do is mimic and imitate what the wealthy do. I am not reinventing the wheel. I am not smart on most stuff. I understand this concept. I understand money, but really, I'm not smart. It took me 13 trimesters to go through 10 trimesters of Logan Chiropractic College in St. Louis, Missouri. After I got through school, it took me 2 extra years to actually get my chiropractic license because I kept failing part 3 of national boards. And they only give you the test every 6 months. And I failed it 3 times. I remember my mom sent me this little plaque, and it was a plaque of a little chipmunk, and he was gnawing on like a piece of wood. And at the bottom of the plaque, it said a 3rd time is a charm. Well, no, it wasn't, Mom. I didn't pass a 3rd time. It took me 4 times to pass that stupid test. And they only gave it to you once every 6 months. So I had to wait 2 years. So I am not the sharpest tool in the shed. I'm not the brightest candle in the cake. And some people even tell me I'm a couple donuts short of a dozen, but I understand this and I understand this quote. And all I'm going to do is mimic and imitate and duplicate what the wealthy have been doing for over 200 years. Only 1 of 2 things are going to happen to every one of us on this call. Every one of us. We're going to live or we're going to die. Now, I like to use the word graduate, but you use whatever words you want. If we live, are we better off with or without this concept I just shared you? Hopefully you say with. It's not an when or if we die or graduate. It's a when, right? We all have an expiration date. We just don't know when it is. But when we pass, die, or graduate, are our beneficiaries better off with or without this concept? That's right, with, because of the death benefit. How much tonight did I even talk about life insurance or death benefit for that matter? Hardly at all. Look, life insurance is the tool that we're going to use to build, keep, and create wealth. If I could do this with water bottles, I'm holding a water bottle in my hand. A lot of you can see it. If I could say, hey, ladies and gentlemen, boys and girls, go buy a water bottle to build, keep, and create wealth, and you'll be able to do fine. No, it's not a water bottle. I don't know of another vehicle on this planet with these features and benefits, how to do it other than a whole life policy in a mutual company that pays dividends, that's designed for high immediate cash value. Policies are exempt and from judgments and liens in most states. That's right. Remember O.J. Simpson? He was found not guilty in the criminal case of killing the Goldman kid and his wife, but he was found guilty in the civil trial. But did the Goldman family ever get money? No. Why didn't they get the money? Where was OJ's money at? Remember the late Ken Lay with Enron? He owed all those people money. They had a judgment against him. Did those people ever get the money? No. Why? Where was it? It was protected. The internal value of the policy grows tax-free. See, ladies and gentlemen, boys and girls, what we want to do is we want to pay tax on our money one time only. We want to get that money into a tax-free environment, and we want to have that money get into that tax-free environment, and we want it to grow uninterrupted compound interest with the government completely out of our hair. Do we not? The loan on the policy never has to be paid back. No. The loan never has to be paid back. As a matter of fact, the insurance company will never ask you, why do you want a policy loan? And they'll never ask you if you plan on paying it back, because they don't care. The insurance company can never lose. And here's why. Because the death benefit will always be higher than the loan available and the cash value. And whenever you do pass, die, or graduate, even if you had max loaned out on your policy, what happens is the death benefit will just pay off the policy loan because they've already given you that money while you're living, and the additional money will go to your beneficiaries tax-free. So essentially, what are we doing? We're using our death benefit money while we're living instead of waiting to pass it to the next generation. Believe me, you're going to have plenty to pass to the next generation, but we're using that money while we're living, the cash value available. All right. Why are we doing this? I went over a lot of things tonight, and we're doing this for a lot of different reasons. Here's one.
I want to be so freaking bad. Buy all of the things I never had.
If this is something that you want to do, here's what I want you to do. Oh, and remember, if you want our ebook, send me an email, Brent@themoneymultiplier.com, B-R-E-N-T, Brent@themoneymultiplier.com. Chris Naugle and I wrote this book. We will email you the ebook. Take a picture of this screen right now. Anyway, there's my contact information with my texting information. There's my email address. If you want to know how this process will work for you, you can schedule on that calendar link, or there's probably other calendar links in the chat box that our team has already put in there. You can schedule on any of our calendar links just to get your questions answered on how this concept will work for you. We're not going to ask you to buy anything. We're just going to answer your question. And hopefully, if you decide to implement this in your life, you'll decide to do it with us. Not that you have to do it with us. You can go do it with someone else, but I don't know of anyone else that does it like we do. And on the very bottom there, if you want to go back and watch the presentation in the entirety, or go and check out any spots that I didn't go over tonight, just go to themoneymultiplier.com/presentation, click on Watch Brent Now. I'm about to throw this to Chris, but before I do, a couple resources I want to give you. If you haven't done so already, go to our website, themoneymultiplier.com. We have over 70 plus videos out there. Go to wherever you get your podcast. And so my daughter, Hannah Kesler, which is on the chat box tonight, Hannah has over 60 podcasts. So go to the Money Multiplier podcast, wherever you download your podcast. Hannah is recording a podcast every single week. Go watch all the ones in the archives. Chris Naugle, go to chrisnaugle.com. Follow everything that Chris is doing. Chris does a Wealth Wednesday webinar every Wednesday at 1 p.m. Eastern time. He does another segment every Wednesday at 4:30 p.m. Eastern time. It's called Ask Me Anything, where you guys just rapid fire questions. That's done on a weekly basis. So go follow that. And then also I'll throw out a guy named Burr. His name is Devin Burr. Go to TikTok, Instagram, YouTube, Twitter, wherever you do all that social media stuff. I have a hard time checking email, so I don't know how to do all that. But Devin Burr, he's from Arizona. He's a real estate investor. Devin has almost 1 million followers out there on those social media channels. And Devin shows you how he uses this concept to buy all of his real estate. So lots of different videos on there. I believe you go to MR_Burr, B-R-R-R-R. But his name is Devin, D-E-V-I-N, Burr, B-U-R-R. So check all of that out. A lot of good content, a lot of good information. You can also always Google or YouTube either Chris Naugle or Brent Kesler. Remember, you spell my last name with 1 S and not 2. and there's tons of information out there. I know I went over about 25 minutes. I apologize for that, Chris and Hannah, but I was on a roll. And so I'm going to throw it back to you. And I appreciate all you guys being on and listening. And we are here to serve you. So any way we can help, please reach out. Chris and Hannah, throw it back to you.
So, so somebody asked this at the beginning of the conversation, and I actually got this question here recently, and I want to see how you answer this, and I'm going to tell you how I will respond first, but then Dad, I want you to give, your answer. So, so somebody asked, hey, if you haven't already covered this, can you please tell us the policy or policies that you, Brent, that you actually use to pay off your debt in the 39 months? Because they're trying to figure out what premiums, what dump-ins should they do, what type of design of the policy. So here's how I would respond to it, right? I believe that how fast or how slow you go with this concept is totally up to you. You can start this policy at the minimum premium, right? You can start at your minimums and just truck along with doing that with inside of your policies. Or, hey, you can go faster than that. Just to go back to the example that you showed of the Minnesota chiropractor, let's say instead of him doing 25 a year, what if he did 50,000 a year into his policy? Well, what would happen? He would just go faster than that. He would just get there 2 times quicker. So how would you respond to that? Because it's just interesting. I was asked that earlier.
Yeah, exactly right. I had a guy ask me that, and I think it was a guy, and I'll just call him out. His name is Glenn. He went to your Jacksonville RIA. And he asked that question, and all you really got to do is go back to the map. He said, Brent, how did you pay off $984,000 in 39 months? I just went faster, and exactly what you said, Hannah. Just on that example that I showed you where he put in a $25,000 premium, paid off $470,000 in 61 months. If he was putting in more premium, he would have paid off more debt. It's all just numbers, but I can't sit here and tell you exactly what I did month after month or each month. Because back when I was doing this, I never thought I was going to be teaching this, and I was just doing it in my own life. But just to give you the high level, to get pretty close, is I started my first policy in 2008. It was February of 2008. I started it with $2,000 a month. Because I had to start it monthly, I didn't have the money to put it all in annually. So then I started another policy shortly after that for $2,000 a month. Then I did one for $4,000, another one for $4,000, and I just kept buying policies. So now fast forward, now I'm at 25 policies, about $700,000 a year in premium, and I'm buying a policy once a year, once every couple of years. As you know, Hannah, I'm trying to get anywhere between $500,000 and $750,000 of premium in a new policy that we're currently working on. As you do more, you just have more and more money. And as the policies get older, the policies just continue to grow and get bigger. Now, as far as policy design, every single one of the policy designs that I own, it's either base 40% and PUA of 60%, or it's base 60% PUA of 40%. I recommend when you buy policies on children that you put more into the base and less into the PUA. And that's my reason for 60 base and 40 PUA. A lot of you guys get all wrapped up in these dump-ins, and you want to put a boatload of money in the policy, or you want these policies that are going to give you 80, 85, even close to 90% of cash value in the first year. I don't own any of those policies. Now, there's a place for all of those, and we can have an argument all day long to why those are better and compare apples to oranges. I personally don't own any of those super, super high first year cash value policies. I don't think, Hannah, correct me if I'm wrong, but I don't think I own any policies that have any term insurance on them. I'm not a big fan of doing dump-ins, because when you do dump-ins, and you design those policies that way, you got to throw a lot of term insurance on them, and it inhibits you from what you can do later. That's just me. It's not a right or a wrong. So like if you're on this and you're thinking, oh my gosh, why did they have me do that term insurance or that big dump in? Everybody is in a different situation. There's no right or wrong. I'm just in this thing for the long haul. I'm in this to leave my family a legacy and to get as many of these policies as I possibly can get. So to answer the question about me personally, the design was base 40 PUA 60, unless I bought the policy on a minor and then it was base 60 PUA 40.
Can you explain more about how you take a policy out on somebody else? He's 74, and how can they take the policy out? Can you explain the owner, the insured, and the beneficiary? I can answer, but I'll give it to you though.
Yeah, I'll go ahead and answer. Yeah, so like if just for some, well, actually at age 74, as long as your health is okay, that's okay. You're not too old. I think Hannah, so the oldest person you got a policy on was like 76 or 77, but
78.
so okay, age 78. So anyway, don't think because you're 74 you're eliminated, but let's just say you are eliminated for age or health. So all you got to do is just have another body that's going to agree to let you insure them. It could be a spouse, a child, a grandchild, a business associate, someone you have a vested interest in. So they have to agree to let you own a policy on them, unless it's a child of yours and they're a minor. They don't have to agree because you basically own that child until they're 18. After they're 18, then they have to agree. So basically you own and control the policy. So there's three things on every policy. There's the owner. So he or she who has the gold makes the rules. The owner usually pays for the policy. Then you have the insured individual. The insured individual is the person that pees in the cup and gives the blood and answers the health question. Unless it's a minor, then they don't necessarily have to pee in the cup or give the blood. And then the beneficiary is who's going to get the proceeds when the insured passes. Now, the owner and the insured can change at any time and multiple times. The only thing that cannot change on the policy is the insured individual, but the owner and the beneficiary can change. I threaten my kids all the time. If they don't act right, I will remove their ass from being my beneficiaries, right? So just because they're my beneficiaries now, if they don't act right or screw up, I can take them out of being the beneficiary. So it's not a hard process. Our team will help you with that. All you got to do is tell us kind of what you're looking at and what you're thinking.
Kind of like this question because it's
I
the
can show
very
it right
big,
here.
it's a big argument between like the Dave Ramsey fans of, hey, buy term, invest the difference, well, hey, when you graduate or when you pass away, you don't get any of that cash value. So here's something to understand. Because the question is, well, hey, when I pass away, what happens to the cash value inside of that policy? And so the answer is, it's the same. The cash value is literally the same thing as that death benefit, because here's what it is. And sorry if I'm being a little confusing with that statement, but here's what I mean. The cash value in the policy is simply a prepayment of your death benefit. So to give you a number example, let's make believe you have $1 million of death benefit on your body. And during your lifetime, you have taken out and you were using $600,000 of loans. That's outstanding on the policy. Well, then what's going to happen at the time of your passing is that 600,000 will get subtracted from your 1 million in death benefit. If you don't use any of the cash, if you don't use any of the cash value, that full $1 million is going to get paid out to your beneficiaries. But because you are using it, you're using that 600, the difference, that 400, then gets paid out to your beneficiaries. So here's an example for my folks in the real estate world. Let's make believe you have a house and it's worth 500,000. And let's say that you have equity inside of it of 250,000. No, you're not going to just go and sell the house for 750,000. No. The house is worth 500,000. You just built up the equity of up to 250. So I hope that analogy resonates with some people.
Yeah, I mean, I did a
Yes.
bunch of things, but it's right here. If someone puts 20 grand away each year, you can see in year one, their death benefit's 359, but by the 10th year, their death benefit's 671.86. So why did it increase? The cash value drove the death benefit up, because you can't have more cash value than you do death benefit. It's that simple.
Yeah, so basically just look at it as the cash value is a prepayment of the death benefit. So at the time of your death, you have the full death benefit. Like Hannah's example, the death benefit is $1 million. And if you have $600,000 in cash value and there's no policy loans, then the $1 million will go to your beneficiary. Well, hopefully you've been using the cash in the policy while you're living. So let's just say you've got it maxed out and you've got $600,000 that you've taken out of the policy. The death benefit is still $1 million. It's still $1 million. They just are going to pay off the $600,000 policy loan because they've already given you that money while you're living, and the additional money goes to your beneficiaries, in this case, $400,000 tax-free. So a policy loan is simply a prepayment of the death benefit. The only time your cash value will equal your death benefit is at age 121. At age 121, the insurance company will pay you out your death benefit. They don't want to deal with you past 121. They're tired of playing with you in the sandbox. So if you live to 123, the insurance company will not play with you for the last 2 years. They will pay off, so at your death benefit at 121. So I suggest when you get to about around age 118, call us and we'll start having the conversation.
Well, I think we got to the end. We're about 36 minutes over time. So I'm going to wrap on that. Folks, thank you all for joining us tonight. In the chat, we did put on there the way to book a call. And if you took a screenshot of Brent's screen, you can also book a call directly with Brent. So either way, we're standing by, waiting to help, waiting to take your calls. Happy to help and happy to do all that. But also on there, it shows all of the different events we have. We have 3 events going on just tomorrow. So please join us for those events. Tomorrow on the Wealth webinar, I can cover some of the advanced trainings that we've got. But there's the link to schedule the calls. I've been trying to share that throughout. But I'm happy to go through, share what I came up with. I wanted to show the retirement strategies on, we call it SLRP, Supplemental Life Insurance Retirement Planning. It's something that we've covered in prior videos that we've done.
So are you telling us that tomorrow at Wealth Wednesday webinar, you're going to go through the SLRP method?
I certainly can.
All right, I say we do that.
Yeah, I mean, I got it all prepared. I mean, that's what this is. And then I also have, a SLRP for kids. And this is ridiculous. I mean, I just did this on a 5-year-old and I just ran it. I showed putting $8,000 a year in for 10 years for your child, then $2,400 a year, from year 11 to age 50, you put in 161.6. The total income from age 50 to 85 is $958,968 tax-free income to your child. The cash value at age 50 is $624,000. The cash value at age 85 is still $617,000. So what I'm trying to show you there, we took $958,968 out tax-free, and the cash value hardly moved from age 50 to 85. That is the power of this. That is the power of time and compound interest. The death benefit at age 50 was 1.5 million. At age 85, after taking almost $1 million out, is still $1,099,000. It's this child during their life still had full liquidity. The money was all tax-free. It provided the ultimate legacy. And what was put in? $161,600 from age 5 to age 85 when I kind of just stopped it because I could have kept going. And listen, I have examples where I show you what I did with my daughter, and it's called Vivi Lucky Jeans. I'm happy to share all this stuff, on the webinar, but this is the power of it. I mean, you want to do something for your child, you want to set them up for the future. I mean, come on, it doesn't really get any better than that for a setup. It really just doesn't.
Okay. All right. No, I love it. No, and I know. And Chris, because you've been on the road a lot, so go spend time with your family. But I will say this: once you leave this meeting, because you are the host, it will end it all.
I know. So I can keep it going.
No. Well,
No, we're good.
yeah, no, that's okay. So I guess tomorrow. So that's all good. So tomorrow we'll go through the slurp. I'm gonna make myself available at 1 o'clock. And for everybody, I did put the link in the chat. So, and that's every single Wednesday. The Chris goes live at 1 o'clock Eastern time
Every week.
and then actually even after that, we do the live 4:30 Ask Me Anything segment.
I'll be back tomorrow, giving for what the F happened in the morning, wealth webinar in the afternoon, and then ask me anything after that. So
Yep. And just real quick,
party
yes,
rolling.
all of his segments get recorded and they get posted on his YouTube. So go subscribe to Chris Naugle's YouTube channel.
Yeah, and then for all of you too, with what Brent said, just right there in the chat, make sure you save that. That's the link to set up a call, and then we can go into your particular situation. So a lot of people had a lot of questions, and if you scroll up here, I'll put it in one more time. A lot of people are asking, how do I register for tomorrow's wealth webinar? So I'm going to put that in there. So this is how you register for all of the different events that we have tomorrow. It's right there. So the wealth webinar, you just go to chrisnaugle.com, register for the wealth webinar. The WTF show in the morning, you just go on YouTube, subscribe, and click the alerts button. It'll notify you when we're going live. And then ask me anything, same thing, the YouTube or Facebook channels, to show you how to do all of that.
Awesome.
All right, folks. Well, thanks. It was awesome. Brent always crushes it. And Brent, like a lot of people were saying, that they liked when you went a little bit slower. You were saying it's because, you were sick and just getting over it. I actually enjoyed it more too when you were a little bit slower, because it just lets things land. So when you did the car example, like things just landed on it. So I don't know, maybe there's something to that. Instead of an hour and a half, maybe we just got to go 2 hours from here on out.
Yeah. Anyway, so like pretty soon I guess I'll discover a way to get these things to 3 hours.
Well, we've done it in the past. We can certainly do it again. It's not
I feel like
very
the
hard to do.
older I get, the slower I get, man. But
Nothing wrong with that, man.
as long as we get the information out there,
What do they say? They say slow is fast, and that's
Yeah.
the best analogy. But with that, folks, thank you all for joining us tonight. We really appreciate it. I hope you all apply this, book some appointments so we can talk about your particular needs, and we are here to serve. And we'll be back tomorrow morning, 9:30, straight through, to serve you even more. Thanks, everybody, and have a good night.
See you guys. Thanks.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.